Money that works for you instead of you working for money. Sounds like a dream, right? But here's the shocking truth. While investing can build wealth, picking the wrong investment vehicle can cost you thousands. Did you know that over the last 15 years, about 90% of actively managed funds got beaten by a simple index? That's thousands of professional money managers with their fancy degrees and powerful computers losing to an investment that basically runs on autopilot. Curious why? Let me break down the battle between mutual funds and index funds that could make or break your financial future. Definitions and basic concepts. So what exactly are we talking about here? Think of mutual funds as big pools of money gathered from thousands of investors like you and me. A professional manager then takes that pool and buys stocks, bonds, or other investments they think will make us money. It's like hiring a financial genius to manage your money alongside other people's cash. Currently, there's about $63 trillion globally invested in these funds. That's trillion with a T. Index funds? They're actually a type of mutual fund, but with a crucial difference. Instead of paying someone to pick winning investments, index funds simply copy an existing market index, like the S&P 500. The first one was created back in 1976 by a guy named John Bogle, who founded Vanguard. People thought he was crazy. Now, about $21 trillion sits in these index funds worldwide. But which one deserves your hard-earned money? Let's dig deeper. Key structural differences. The biggest difference comes down to management style. Think of mutual fund managers as active hunters, constantly searching for undervalued companies and market opportunities. They're making predictions, analyzing earnings reports, and sometimes even meeting with company executives. They're trying to beat the market. Index fund managers? They're more like photographers, simply taking a snapshot of whatever index they're tracking and replicating it. No predictions, no stock picking, just mirroring what's already there. This difference creates a ripple effect. Mutual funds typically have a portfolio turnover of 60 to 100% annually. What does that mean? They're replacing 60 to 100% of their investments each year. All that buying and selling creates costs and potential tax headaches. Index funds, meanwhile, typically turn over just 4 to 10% of their holdings each year. They only make changes when the index they track changes. And transparency? With mutual funds, you generally only see what they're holding 4 times a year in quarterly reports. Ever wondered what your fund manager bought last week? Good luck finding out. Index funds are crystal clear. You always know what they own because they're simply matching their target index. Wait, but don't mutual funds have those brilliant managers making smart decisions? Shouldn't that lead to better returns? Let's see what the numbers say. Performance comparison. If you invested in the average actively managed large-cap mutual fund over the past decade, you'd have earned around 9.8% annually. Not bad, right? But if you'd simply bought an S&P 500 index fund, you'd have earned about 11.5% per year. That 1.7% difference might not sound like much, but compounded over decades, it's massive. On a $10,000 investment over 30 years, that's the difference between ending up with about $143,000 versus $230,000. But maybe the mutual fund managers just had a bad decade? Unfortunately, the data shows this isn't a fluke. Year after year, around 75% of active managers fail to beat their benchmark indexes. And those who do manage to outperform rarely maintain their winning streak. Think about that for a second. Most professional investors, with all their resources and expertise, can't consistently beat a simple index that's just following a formula. Why? A big reason comes down to one word: fees. Cost comparison. The average equity mutual fund charges about 0.94% annually in expense ratios. That means for every $10,000 you invest, $94 disappears each year in fees. Index funds? Many charge as little as 0.07%, or just $7 per $10,000 invested. But wait, it gets worse for mutual funds. Many also charge loads, sales fees of up to 5.75% that come right off the top of your investment. Invest $10,000 and immediately you only have $9,425 working for you. Some also tack on marketing fees called 12b-1 fees, up to another 1% annually. Let's put this in perspective. If you invested $10,000 for 30 years, the difference between paying 0.9% in fees versus 0.07% would mean about $40,000 less in your pocket at retirement. That's not just money. That's vacations not taken, gifts not given, or even years of retirement you can't afford. And we haven't even talked about taxes yet. Tax efficiency. Remember that high turnover in mutual funds? All that buying and selling creates taxable events. When a fund sells investments at a profit, those capital gains get passed on to you, even if you didn't sell a single share. The numbers tell the story. The average tax cost for active equity funds runs about 1% annually, while index funds typically cost around 0.3% in tax drag. Another 0.7% silently eroding your returns each year. Think about it this way. Between higher fees and higher taxes, many mutual fund investors are starting each year in a 1.5% hole compared to index fund investors. That's like running a race where your competitor gets a massive head start every single year. So why would anyone choose mutual funds? Are there situations where they make sense? Who should choose which? Despite their challenges, mutual funds can shine in certain situations. Some market segments, like small-cap stocks or emerging markets, aren't as efficiently priced. A skilled manager might actually find hidden gems there. If you can identify those rare managers who consistently outperform, they do exist, just not many. Active funds could work for you. The challenge is finding them before they outperform, not after. Index funds make the most sense for long-term investors who want broad market exposure, people who don't want to research dozens of fund managers, investors who are sensitive to costs and taxes, those who accept market returns rather than swinging for home runs. The truth? Most people would be better off with index funds as the core of their portfolio, perhaps with a few select active funds in areas where they bring unique value. Getting started. Getting started with either type is surprisingly easy. You can invest through a regular brokerage account for non-retirement investing, IRAs, traditional or Roth, for retirement savings, your employer's 401k plan, which may offer both options. Index funds typically have lower minimum investments, sometimes as little as $1, while some mutual funds require $1,000 or more to start. For beginners, a simple portfolio might be 80% in a total stock market index fund and 20% in a total bond market index fund. As you learn more, you can add international exposure or perhaps specific sector funds that interest you. The key is starting now. Even small amounts invested regularly grow substantially over time. The battle between mutual funds and index funds isn't just academic, it's about your financial future. The evidence is clear. For most investors, index funds offer a simpler, more cost-effective path to building wealth. They deliver what the market gives minus tiny fees. Mutual funds promise more, but often deliver less after their higher costs. Remember, an extra 1 to 2% in returns might not seem like much today, but compounded over decades, it could mean working years longer or retiring years earlier. Your choice matters that much. What's your investment strategy? Are you paying too much for underperformance? Could a simpler approach actually give you better results? The answers might surprise you. If you found this breakdown helpful, smash that like button and subscribe to the channel for more no-nonsense financial guidance. Hit the bell icon so you never miss future videos that could literally save you thousands. Drop a comment with your biggest takeaway or questions about investing. I read every single one. Here's to building wealth, one smart decision at a time.